So hello everyone and welcome to the second session of tax module. I will share with you the material of the next session always in advance and also the recording sessions as soon as possible in order to have time to review and ask your questions. As Oliver informed you already, the first session was the most complex one. So if you have any questions so far, feel free to ask before we start. Welcome, Oliver.
And welcome to today's webinar on substance requirements in the context of private equity investments. Before starting with the second module, select the question whether you had questions since yesterday, and probably also, I appreciate that yesterday was definitely the most complex session of the four and the least intuitive. I mean, the hybrid mismatch rules are definitely the most complex tax rules that have ever been implemented in Luxembourg, and it took me several months full-time study to really get through it. And so far, if you didn't get everything the first time, that is not an indication of limited comprehension capacity. I mean, probably the key takeaways that you should take from this session is we have hybrid mismatch rules. Hybrid mismatch rules might in particular be a topic in case of Luxembourg partnership funds, like in the form of an SDS, SCSP, because from the perspective of some investor jurisdictions, a Luxembourg partnership, which is transparent from a Luxembourg perspective, could be classified as opaque from the investor jurisdiction. Now, the thing is, obviously when we structure a private equity fund or real estate fund, we are not looking to obtain a tax benefit through the implementation of a hybrid entity in the form of a fund vehicle. It's just kind of a mere consequence of the classification of the fund vehicle in the investor jurisdiction. So, but while one need to have it on the radar and one need to analyze whether one has a concern here, I also say one does not need to lightly conclude that the hybrid mismatch rules may apply in a given case, because I mean, there are so many tests that need to be run until one in the end would conclude, okay, here the hybrid mismatch rules apply. I mean, based on experience, I mean, very often the hybrid mismatch rules do not buy in an alternative investment fund context. And how I used to say, the complexity of the hybrid mismatch rules is also an opportunity to manage the impact in practice. So that means either they may not apply in the first place, or one has opportunities to, or solutions to manage the impact in practice. Yeah, so having said that, and I guess there is no question. I just opened the chat function. So if there are questions throughout the presentation, I mean, again, please feel free to ask them. And I mean, as I see the questions coming up, I may answer to them at the end of a part of the presentation. Yeah, today's webinar focusing on substance requirements. So I guess the presentation will last an hour 15, so that would also allow us enough time to ask questions afterwards. And also, I mean, depending on the time that we have at the end, we can also still speak a bit about how to manage substance requirements in the times of lockdowns and quarantine mandates, because there's a very current angle to the management of substance. Beginning with a little introduction, I mean, Luxembourg is a prime holding jurisdiction, a fund location, and substance was always a topic that was relevant for Luxembourg investment structures, because I mean, we hardly ever have Luxembourg structures. I mean, typically it's always even through-bound structures, meaning you have a foreign investor investing via Luxembourg into other countries. And that means I mean, here we need to ensure that the Luxembourg company is resident for tax purposes in Luxembourg, and then also the substance need to respond to the requirements in the investor and in the investment jurisdiction. So that was always the case. Then again, like here, this OECD BEPS project that has been launched in 2013, also with a lot of like political dimensions behind. There was a strong call for more economic substance, and actually, like at the time, the spirit was a bit like, yeah, in investment structures are kind of bogus. You know, why do you have an entity somewhere in between? So there was a lot of uncertainty where all of this would be landing in the end. But so like the positive thing is like in the meantime, we have these final reports on the different BEPS actions, and also we have like a new case law from the Court of Justice of the European Union that is very helpful in order to have more clarity on how say like an appropriate substance can be defined. So far we have a bit of light at the end of the tunnel. Looking first at the notion of substance, so that we are all on the same page with regard to what is substance in the context of international taxation. Probably first to speak, yeah, I mean, substance is important to apply the rules of domestic tax law, tax treaties, and the arm's length principle. So yeah, we will go through all the different say like layers of where requirements may come from. I mean, in the context of domestic tax law, of course, we have like anti-abuse legislation that may pick up on certain minimum substance requirements, same in tax treaties. And when it comes to the arm's length principle, there we have a number of concepts that directly relate to substance. And when we speak in the context of a private equity investment structure, I mean, here we are typically speaking about like safeguarding certain tax treatments, such as obtaining a withholding tax exemption on interest and dividend payments made by the target company to the Luxembourg investment platform. And yeah, the reason why we are speaking about substance, because normally you could say like, yeah, okay, I mean, if, I mean, we just put an excessive substance in an investment structure and then we do not have any problem. Okay, but there's also a thing like, say like there is a cost associated to substance, and therefore it also makes sense to look at, yeah, what is the, say like the minimum substance, in order then to be able to stay away from the minimum substance or from the red line. But on the other hand, one can also not just say like, yeah, we hire 5 people more in order to be sure. That does also not make sense, apart from what do people do potentially. So if the work is not there and just hiring people in order to say we have substance, does also not make sense. And probably like how that topic about substance emerged over time. I mean, probably 10 years ago, you had people that said like, yeah, substance is not a big issue in Luxembourg. And today the same people are saying, okay, substance, you need to put one body in each box, like you need to hire someone in each company. I would disagree with both positions, because it's about determining an appropriate level of substance and not about like either we don't care or we panic. Now looking at the different dimensions of substance. So one dimension would be infrastructure. So that is, say like all the tangible elements such as office premises, employees, IT equipment, email addresses, and any way how the existence of the Luxembourg companies, say like are visible to the outside. Then we have corporate governance. Corporate governance would include like the composition of the board of directors, and then the profile of the directors. So are that experienced people or not? Then the involvement of the Luxembourg directors, so that Luxembourg directors are not merely rubber stamping like documents that are provided to them, but that they are involved in the discussion process, that they contribute their views, and that they are fully involved in the management of the company. Then board meetings that should be held in Luxembourg with the presence of all directors ideally. Then the preparation of proper board minutes where like the discussions in the director meeting is properly documented. While I normally do not like so much administration, but unfortunately, this documentation and producing minutes that are more comprehensive than in the past is now like really important to properly document the substance. And then one should not forget that substance might be tested a few years down the road. And that means when then after like 2-3 years, you need to prove that 2-3 years before the entity was properly managed in Luxembourg. I mean, you might have difficulties if you did not properly document that. Then legal documentation, also very important, so that when investments are implemented, that the legal documentation, like loan agreements and this kind of stuff, is properly documented at the time the investment is structured. Then the next dimension of substance would be the functional risk profile. In other words, the functions that are performed by the entity and the risks that are assumed by the entity. So, I mean, functions, I mean, a Luxembourg company might take a number of, take over a number of functions in regard to the investment activities like monitoring, say like the underlying business, taking care of compliance requirements and so on and so forth. So, but I mean, in practice, one can identify quite a long list of activities that are performed by Luxembourg companies. Then with regard to risk management, risk management is a function that became more important over the last year since the Luxembourg tax authorities released a new transfer pricing circular that provided for a new transfer pricing regime for finance companies. In the past, Luxembourg companies performing financing activities would only bear a very limited credit risk in regard to the financing activities, like 1% or 2 million. And under the new regime, a Luxembourg company would bear all the credit risk in relation to the financing activities. So it means like when a Luxembourg company performs financing activity with a quantum of 100 million, 100 million is at risk. Not like in the past, it would only be 1% of that. And obviously, if you have 100 million potentially at risk, that's a different risk profile than if it's only 1 million. And directors have a good right to be a bit more nervous about this risk and to properly manage the risk. And in this regard, also the preparation of proper transfer pricing documentation and regular reviews, which should be done internally. And then if the facts and circumstances change, then probably we'll need to update the transfer pricing documentation. And last but not least, commercial and legal reasons. I mean, here there are the aspects like why do you go to a certain location, like Luxembourg? And I mean, here we have like a lot of arguments. I mean, it's the investor and lender familiarity with Luxembourg. It's like the legal and regulatory environment that we have. Then one point that is always mentioned in the examples is the qualified multilingual workforce. But then also like when we look at say like existing business relationships, or like if an investor or an asset manager structured already like 3 funds in the past, I mean, obviously there exist relationships with all the service providers, and it's only natural that Fund 4 is also established in Luxembourg. And then one thing that we should not forget, even so we sometimes might complain about service providers, but given the specialization of Luxembourg in the fund industry, I mean, the quality of service providers in this respect is fairly unique compared to other jurisdictions. And so far, that would all be arguments I mean, if one would like to make the case, why are you in Luxembourg? What do you do in Luxembourg? So that would be a 360-degree view on substance.
Oliver, this is Vincent. I have a question.
Yeah.
Is it timely, or shall I ask it afterwards?
No, go ahead. Let's. I mean, to be quite frank, I have a preference for a bit more dynamic way of presenting, which is a bit difficult in the webinar style. But I mean, let's go for it. We have enough time, and.
Okay, so I'm Vincent from ING Bank. With regards the functional and risk profile in terms of substance, in the context of private equity funds, this function is generally outsourced to a regulated investment manager, the AIFM.
Yeah, even so,
and,
like, yeah.
And my question is, as the AIFM can be passports and can be, you know, operated outside of Luxembourg, does it become critical for, from a substance point of view, when the AIFM is located outside of Luxembourg?
So I would, I mean, probably to answer short, no, it should not be a problem, because somehow the fund need to be properly managed in Luxembourg, even so you have the fund management services delegated, and that would likely be portfolio management, marketing, and fundraising, this kind of stuff. So that should not be a problem. And then it's also like, when we speak about substance here, it's more the Luxembourg subsidiary of a fund. When we speak about functional risk profile, and so the fund vehicle would be the one that receives fund management services then from a Luxembourg and a foreign AFM. But the Luxembourg fund, I mean, if it's a Luxembourg partnership, would be managed by a Luxembourg GP, which then would ensure that the Luxembourg fund is considered a Luxembourg fund and not deemed to be a foreign fund just based on the fact that it receives services from abroad.
Okay. Thank you.
My pleasure. Okay. So now looking at the different reasons for substance requirements. So, I mean, we might have substance requirement based on, or from a Luxembourg tax and regulatory perspective. There might be substance requirement from a foreign tax law perspective, mostly anti-abuse legislation. Then in the tax treaty context, there might be substance requirements. Then when we speak about transfer pricing, there might be substance requirements. And last but not least, reputational risks are also a source of substance requirements. And now we will go through one by one as to what the exact substance requirements are. So first of all, when we have a Luxembourg company, we need to ensure that it is considered a Luxembourg company from a Luxembourg and international tax perspective. And for that reason, we need to ensure that the place of effective management is deemed to be in Luxembourg. So that means all the important decisions in regard to the conduct of the company's activities need to be taken in Luxembourg. So with the physical presence of the directors in Luxembourg. To put it like this, I mean, to manage Luxembourg tax residency, that is really like kind of a minimum substance. Because, I mean, yeah, you need to ensure like Luxembourg directors and yeah, that decisions are taken in Luxembourg. So that you make sure that you do not take the important decisions in regard to the Luxembourg company in a foreign jurisdiction. So there, I mean, we would have the problem, but we will afterwards see that here managing tax residency is not the standard that determines the substance requirement in Luxembourg. I mean, just to make the case, this is really like the basic that need to be fulfilled. So like in an international tax context, I mean, if we have a Luxembourg company that is incorporated in Luxembourg, and if now like another jurisdiction, let's make an example. So we would have like the board of directors composed of, say, like 3 German tax residents that all live in Frankfurt. And the 3 guys never come to Luxembourg. And they take all the important decisions regarding the conduct of the Luxembourg company in Frankfurt. Then under the tax treaty concluded between Luxembourg and Germany, the so-called tiebreaker rule that applies when these, say like the seat of the company and the place of effective management are not in the same jurisdiction, and then priority is given to the place of effective management. That means the Luxembourg company that is managed out of Germany would be deemed to be a German company from an international tax perspective. So therefore, it's important to make sure that no other jurisdiction can claim the tax residency of a Luxembourg company. Then when we come back to the investment structure that we saw already yesterday, so here we have a Luxembourg fund investing via a Luxembourg holding company here into a Luxembourg property company that holds foreign real estate. The Luxembourg holding company is financed by an interest-bearing loan granted by the fund and uses the funds in order to finance the Luxembourg property company. The Luxembourg property company would be subject to tax in the investment jurisdiction and is then also subject to all the rules that apply in this case. Now the Luxembourg holding company, assuming that it has the functional risk profile of a finance company, has to comply with the substance requirements that are set out in the transfer pricing circular issued by the Luxembourg tax authorities that apply as from 2017. I mean, we will speak in more detail about that, say like during tomorrow's session on transfer pricing, but here just to speak a bit about the requirements that are set out in this transfer pricing circular. I mean, there should be qualified directors. So that means like, yeah, I mean, there should be experienced people. One should have at least 50% Luxembourg resident directors. The circular reads there should be a majority, but in practice it's agreed that at least 50%. Then these people should be properly involved in the management process. And so, as mentioned already before, the Luxembourg director should be properly included in the process of managing the company. So that means there should not be, say, like a director's meeting and one day before the people just receive a 100-page document that need to be signed on the next day at 10 o'clock, because that is not really like being properly involved. And that is something that should also be documented, I mean, through emails, and so how one can see how the Luxembourg directors are involved in the decision process. In principle, the circular states that a Luxembourg finance company should have like qualified staff to manage the activities. However, a Luxembourg company can simply outsource certain activities, but then the directors of the Luxembourg company need to monitor these outsourced activities. And so overall, I would describe this as a qualified minimum substance. So that is really like, I mean, that is how one properly manages the tax residency and the activities of a Luxembourg company. Then a last point from a Luxembourg perspective would be substance requirements from a regulatory perspective. And when we speak about substance requirements from a regulatory perspective, I mean, here it would be the CSSF that would set a standard that has nothing to do with minimum requirement from a tax perspective. So that means like, yeah, I mean, when the CSSF tells you like, yeah, we want to see this and this substance elements, then that it, and that is completely independent from minimum requirements from a tax perspective. Now looking at substance requirements from a foreign tax perspective. So here there are like three main rules where substance requirements might be relevant. So like anti-treaty or anti-directive shopping rules. That is also what we will be focusing on in the context of private equity and real estate investments. The other rules that might set a certain or require certain substance are the controlled foreign company rules. However, these should not be relevant in the context of Luxembourg fund structures. And the same for the general anti-abuse rule. If a Luxembourg investment structure is properly managed, there is no room for the application of a GAR. So looking now at the anti-directive, anti-treaty shopping rules. So again, like looking here at our investment structure. So we have the Luxembourg fund investing via Lux Holdco into Luxembourg or local property companies. And let's assume it should be local property companies, because then say like foreign tax law applies in regard to potential withholding tax on interest and dividend payments, because from a Luxembourg perspective, if you have a Luxembourg property company, we do not have any concern in regard to withholding tax on interest payments or withholding tax on dividend payments, because here the Luxembourg participation exemption regime would apply. This is also probably like a little hint, like whenever possible, one would structure real estate investments in foreign real estate via a Luxembourg property company, unless there are good reasons to structure investments via foreign property companies. Because if you have a Luxembourg property company, you do not need to bother too much about like substance requirements from abroad, because they do not apply. If you have, however, now a local property company, then the tax law of the investment jurisdiction may say, in general, we levy a certain withholding tax on interest payments or a certain withholding tax on dividend payments. Then there might be exemptions under an applicable tax treaty or under EU directives. However, then again, they apply like these anti-directive, anti-treaty shopping rules that may set out certain minimum standards in terms of substance, and deny treaty benefits or directive benefits if these substance requirements are not fulfilled. And here, obviously, like different jurisdictions have like a different attitude towards taxpayers. And if one can avoid it through simply using a Luxembourg property company, that can make life easier. Then the question is like, in general, yeah, how much substance do I need in order to comply with all the requirements from a foreign tax law perspective? And yeah, I mean, there's no real black and white guideline what one need to have in order to have enough. So rather, the substance need to be appropriate for the activities performed. That means like the magnitude of the activities, the type of activities that are performed. And the question is also like, yeah, I mean, like first of all, like, do I obtain some kind of benefit, such as a withholding tax exemption, or do I not even obtain any benefit over the lifetime? So if there's no benefit, then there's also no incentive of foreign tax authorities to challenge the substance. So therefore, that always needs to be analyzed on a case-by-case basis. And yeah, different jurisdictions or the tax authorities of different jurisdictions have like a different attitude towards, say, like taxpayers. Some are more restrictive than others. So like typically, like countries like Italy and Spain can be quite burdensome. But I mean, also others. And I mean, given the current circumstances and the way so like government spending will result in a need for more, say, like tax revenue, I would not expect the attitude of the tax authorities around the globe becoming more relaxed. Now, so like here, this very soft guideline as to what is an appropriate substance is a bit easier in an EU context, because and mostly our investments that we do via Luxembourg are in an EU context, because in an EU context, so like we have the case law of the Court of Justice of the European Union, and anti-abuse legislation need to be interpreted in accordance with EU law, and very important, as interpreted by the Court of Justice of the European Union. And so here we have the fundamental freedoms and also the EU directives that provide for protection. So like it was back in 2006 where the Court of Justice of the European Union already took a decision in the Cadbury-Schweppes case, where the court defined its wholly artificial arrangement doctrine. Now, 2006 was a long time ago, and I remember back in 2013, people were wondering, yeah, given all the political context, would the court in 2013, 14, 15, 16 still decide as restrictive as the court did in 2006? And so no one, or so like people were hesitating about the answer to that question. However, then in 2017, we had like two very important decisions. Like one decision was in regard to a French anti-abuse rule, which was a principal purposes test adopted under French tax law. A principal purposes test, we will see that afterwards, is also something that has now been included in bilateral tax treaties. And yeah, here the court decided that the PPT under French tax law was not consistent with EU law. And in the meantime, this rule has been abolished by the French legislator. And we had like two decisions in regard to German anti-treaty, anti-directive shopping rules. So there was one decision at the end of 2017, so before Christmas, and it felt a bit like a Christmas gift because it was in regard to the rule from 2007. So it means like in 2007, Germany implemented this anti-abuse rule with excessive substance requirements, and it took like 10 years until one could conclude that this rule was clearly inconsistent with EU law. So after that, the German legislator released a circular where they tried to interpret their, say, like 2011 amended version of this rule, consistent with this case law. But in the meantime, the Court of Justice also dealt with a case with this 2011 version of the rule, which was a bit softer than the 2007 version. Yet again, the court concluded that this rule was inconsistent with EU law. And since then, like Germany had to abolish this rule. And now, yeah, in the meantime, Germany released a draft law for a new anti-abuse rule, which would be kind of a principal purposes test. However, and as we will see afterwards, also this principal purposes test need to focus on wholly artificial arrangements. And we will see afterwards the elements of that. Then in the meantime, we also had like the so-called Danish cases in regard to like Danish subsidiaries of Luxembourg investment structures, by the way. And here the question was, what does it mean, or what are abusive arrangements and what is beneficial ownership in regard to holding and financing activities? And here the Danish cases are a bit particular, and it gave rise to a lot of question marks because normally in the other decisions before, and like commonly the Court of Justice of the European Union does it, they decide that in a given case, say like there's no abuse. Now in the Danish cases, it was the Danish courts asking, dear Court of Justice, please tell me what is abuse of law and some other questions. And so that means like here, the Court of Justice had to explain what is the scope of abuse of law, rather than when is no abuse of law existing. And so that obviously, and given that this is also always formulated a bit soft, and gave then rise to some uncertainty because like people tend to exaggerate like the scope of vague language. And therefore there was some question mark like, yeah, did the Court of Justice now flip and take a completely different view in terms of like extending the scope of anti-abuse legislation contrary to that what has been said before. And so like the good point is we had already now like one case from the Italian Supreme Court that decided in accordance and making reference to the Danish cases, and concluded that say like a case under their Italian domestic tax law was inconsistent, say like with EU law. So I guess it goes in a good direction. Now looking at the wholly artificial arrangement doctrine, and when looking into the different cases, we have now like really like kind of a checklist what anti-abuse legislation should not be doing. So, or should be doing or should not be doing. So, I mean, first of all, anti-abuse legislation should focus on wholly artificial arrangements. So one example of that could be a letterbox company. Then one need to analyze each individual case, because some anti-abuse legislation has like a list of formatted criteria. And if you do not tick one of the boxes, okay, this is abusive. However, this is not possible. Instead, one need to analyze like all the facts and circumstances of a given case and then evaluate whether this is abusive. Then anti-abuse legislation need to include a substance test. And here the analysis should focus on appropriate substance as opposed to excessive substance. So it does not make sense if you have say like a holding and finance company that has say like limited activity, that this entity has as much substance as say like as a factory where you produce something, because I mean they're simply not the work, so that need to be appropriate. Then also one thing that's very important is that the substance of the entire group in a jurisdiction need to be considered, because some anti-abuse legislation was just looking at the level of the direct parent company. So, and when you consider like a normal investment structure, so you have probably like a Luxembourg master company, and then you have a Luxembourg deal company per deal, and then you have the local bidco and the target company. And then when the local bidco makes a payment to the Luxembourg deal company, then they would only look at the level of the Luxembourg deal company, but not at the substance of the entire investment structure in Luxembourg, while it is very often so that, yeah, you might have substance at the level of the Luxembourg master company, or you might have substance at the level of a management company. And this is then also deemed to be the substance of the entire group in this jurisdiction. Because I remember in 2017, it was also, there was the discussion and the advice about like these shared employment contracts, so that like each company involved bears somehow like some staff costs. And with these decisions, that is a bit off the table, because here now it's clear an entity of a group can rely on the substance of other entities of the group. Then when it comes to what is an economic activity, this need to be understood in a broad sense. So one cannot say like, yeah, a Luxembourg company that is involved in asset management and probably like, yeah, just realizing income from foreign sources would not perform a proper economic activity. No, that is say like a legitimate economic activity under the wholly artificial arrangement doctrine. Then one should disregard the motive for a taxpayer to go to a certain location. That means if a taxpayer goes to a certain location, the only question is he there or is he not there? So if there's a proper substance in a jurisdiction, it does not matter why someone comes to Luxembourg, for example. Yeah, and one thing, like when we have like an EU parent company, say like a Luxembourg company owning other European subsidiaries, one should not deny their directive benefits just because the shareholders of the Luxembourg company are resident in a third state. And yeah, one thing that is important, because some of these anti-abuse rules, you know, just provide for a checklist, and if you do not tick all the boxes, then they would say like, this is now an abusive situation. These rules always need to allow the taxpayer to provide evidence that there is no abuse in a given case. And so I guess if you now look at all these criteria, that provides, in my view, like like a much more reasonable picture when it comes to substance than just like guessing around, like, yeah, what might tax authorities want to have. I mean, this here is pretty clear. It means like, yeah, have an appropriate substance. I mean, afterwards we will discuss about like, yeah, how do we determine like an appropriate level of substance, but it's really like, yeah, how much activity do we have and what might be an appropriate way to deal with it. So now looking at a tax treaty context. So in a tax treaty context, we have in particular the principal purposes test that has been developed throughout the BEPS project and more precisely Action 6 regarding the perceived abuse of tax treaties. And the principal purposes test would deny a treaty benefit where it is reasonable to conclude that obtaining this treaty benefit was one of the principal purposes of any arrangement or transaction. I mean, that is obviously like if you just read it and make a semantic analysis, that might be a very broad concept, and it gave rise to some concern when this came up. In the meantime, we have like guidance in regard to the interpretation of the principal purposes test, and also like some examples that we will go through individually that are very helpful in interpreting this rule. In the meantime, while this rule has been included in the OECD model and guidance in the OECD commentary to the OECD model, the principal purposes test has been implemented in bilateral tax treaties through the multilateral instrument. The multilateral instrument, because I mean the OECD recognized, okay, if we now produce all the guidance on how bilateral tax treaties should be amended, given the long lifetime of a tax treaty, so that can be 20, 30, 50 years, and then tax treaties can be amended and typically through like protocols. But I mean, these protocols, then bilateral negotiations also take like years. So like if they would not have used the multilateral instrument through which like all the, say like parties to the multilateral instrument could make their choices in regard to bilateral tax treaties, I mean, this would be a process that would have taken 10 years. And so now the multilateral instrument provided for kind of a whole menu of like different options to amend bilateral tax treaties. Here, participating countries had the option to choose which of their tax treaties should be covered by the multilateral instrument. And with regard to each individual change or potential change, there have been different implementation options, including the option not to make any change in this respect. And what Luxembourg did is Luxembourg is part of the multilateral instrument and had all the tax treaties applicable at the time covered, but they only adhered to the minimum standard. And the minimum standard was like merely adopting the preamble and the principal purposes test. So the principal purposes test is the main thing that we need to think about when it comes to tax treaties and anti-abuse rules. And so like, yeah, one thing important is, so like in the commentary to the OECD model, we have like 3 examples. One example with an investment platform, one example with a securitization vehicle, and one example with a real estate fund. And not to make things too exciting, I mean, in all the examples, the guidance concludes that in the given case, the principal purposes test should not be applicable, which is also very helpful. So the first example with respect to an investment platform. So here we had, say like investors investing into a fund resident in state T. The fund invested via a holding company resident in state R into the target's resident in state S. So we have like 3 jurisdictions involved. So in this constellation, Luxembourg would be the holding company. And so there, they speak a lot about like the different facts and circumstances, the functions performed by the holding company, and the reasons why one goes to like state R in order to establish the company. I mean, the setup that is described is very much that what we have in Luxembourg. So in other words, in the handout, you find like more information about all of that. I mean, these examples could have been written by Alfie. So it's really positive and reasonable. The other example was a real estate fund. So here we had a fund resident in state C with a Menco in state C, then a holding company in state R with like local property companies in different jurisdictions. And here again, in the example, they describe all the commercial reasons and drivers why the investment structure has been made as is. And in the end, one concludes that the principal purposes test should not apply. So here again, it would be holdco, that would be Luxco. And overall, while select the principal purposes test started probably with a one started with a bad feeling because one did not know how that would be interpreted in practice, and it gave so much room probably to different interpretations. But I mean, this guidance here makes it pretty clear that in the context of alternative investments, if one properly structures investments, one should not be too concerned about that. Yeah, and if we now look at the different so like aspects of substance, so like the features of the location, infrastructure, corporate governance, functional risk profile, and commercial and legal reasons. So like the elements that we discussed at the beginning of the webinar. I mean, here the features of the location are virtually ticking all the boxes. I mean, the story why one is in Luxembourg tells itself. Then in regard to infrastructure, I mean, one might expect a medium substance. So depending on how big the operations are, I mean, asset managers that have a significant investment platform in Luxembourg with a significant number of people, I mean, there we would definitely move to the strong area. Then in terms of corporate governance, I mean, that is just like properly manage the business activities. I mean, here one should have a fairly strong picture. Then the functional risk profile, that might be in the area of medium. And commercial and legal reasons. I mean, here again, if we have like an asset manager that has a long history in Luxembourg, I mean, there one has a fairly strong picture. And so like if the red line is then somewhere below medium, I mean, here we are staying far away from the red line, and one just need to give due consideration to that, whether one is there where we are indicating here, in order to be ready to answer to questions if ever they will be asked by foreign tax authorities. Yeah, then looking at the concept of beneficial ownership, which was in the tax, or yeah, in the OC model and in bilateral tax treaties since long. So in principle, the beneficial ownership applies in a tax treaty context with regard to dividends, interest, and royalties. And it would say that the reduced or zero withholding tax rate is conditional to the fact that the recipient of the income is also the beneficial owner of that income. So that means, in principle, the recipient of the income need to be able to freely enjoy the income and should not have any obligation to unpay the income when it's received. Now, if we speak, for example, about like financing activities, which is probably the most crucial case, because here, when we think about here, Lux Holdco receiving a loan from the fund and granting a loan to, and let's say, a local property company, because in case of a Luxembourg property company, we wouldn't have that issue. So if you have now a local property company, and let's assume in the investment jurisdictions, there would be withholding tax on interest in principle. And then if it's a European jurisdiction, they would have implemented the EU interest and royalty directives. That means if certain conditions are fulfilled, there should be we speak about the tax treaties. So in the tax treaty concluded between Luxembourg and the investment jurisdiction, the tax treaty provides for a zero withholding tax if the recipient of the interest income, that would be Lux Holdco, is the beneficial owner of the interest. So here, obviously, we have a loan of, say, 100 million, financing a loan of 100 million. How do we make clear that the Luxembourg company is the beneficial owner of the interest income? So that is probably like the most critical case. And so like, and that is also like based on, say like the opinion of the General Counsel in regard to the Danish cases, where she sets out like some requirements, like say like the Luxembourg company should bear the credit risk in relation to the financing activities, should realize an arm's length remuneration for the activities performed, should be able to cover its cost, and there should be no legal obligation to on-pay the interest income when received. So that would be typically the case because our transfer pricing regime applicable to finance company would say the Luxembourg company needs to realize an arm's length finance margin. This finance margin should definitely be enough to cover the costs and should normally result in an appropriate profit. A Luxembourg company performing financing activities should bear all the credit risk in relation to the financing activities. So that box is also checked. And then the loan granted by the fund to the Luxembourg company should not include a provision that says like, yeah, on the day you receive the interest income from the related loan, you need to on-pay the funds to me. Now, in practice, one can be even a bit more granular because like the more difficult jurisdictions might play on certain, say like, or might pick up on the fact that the loan receivable is fairly consistent when it comes to the terms and conditions to the loan liability. So therefore, it might make sense also to slightly change the terms and conditions of the loan received by the Luxembourg company and the loan granted by the Luxembourg company. So one could think about like having a different term of the loans. For example, if the expected lifetime of the fund is like, say, 5 to 8 years, and then we would say like the loan granted to the property company has a term of, say, like 10 years, and the loan granted by the fund to the Luxembourg company has a term of 12 years. And then there could be like different interest accrual periods. And I mean, small elements like this. And also one thing in the past, we always wrote like in, say, like here, the loan between the fund and the Luxembourg company, what is the purpose or how will the recipient use the funds? And then that would make a link between the fund granted by the fund to the Luxembourg company and the loan granted by the Luxembourg company to the property company. I mean, obviously, this language would be good to avoid in order not to give arguments to the local tax authorities to say like, hey, this loan is financed by that, so it could have been directly granted to the property company or this kind of discussions. Yeah, and so now like when it comes to tax treaties in an EU context, there again, we have the guidance of the Court of Justice of the European Union that is rather restrictive and therefore helpful when it comes to interpreting anti-abuse legislation in an EU context. I mean, the one thing is the principal purposes test, and there clearly like the wholly artificial arrangement doctrine should apply. And when it comes to beneficial ownership, here the Danish cases should prove helpful when it comes to the interpretation of this concept. And as mentioned before, like, yeah, when it comes to financing activities, which are probably the most crucial, so one can definitely create a proper, say, like, beneficial ownership position through the contractual terms and conditions. Now, looking at substance requirements from a transfer pricing perspective, I mean, I will not spend too much time on this, because in the context of private equity and real estate investments, probably the most crucial thing is like the transfer pricing aspects in regard to financing activities. But I mean, in general, just to give you the flavor, I mean, in transfer pricing, there are a number of concepts that say, like, relate to substance, like functions performed, risk assumed, and assets used, that all functions. When it comes to control over risk, that means like the functions, for example, in regard to financing activities, that one, yeah, controls the risk in relation to their financing activity, having the financial capacity to bear the risk. That means, do I have sufficient equity available to cover the risk in case it materializes? Then concepts like significant people functions, obviously that's also related to substance. Then when we look at the new guidance, or relatively new guidance in regard to intangibles, and also in regard to financial transactions, I mean, here they clearly say, like, the ones that are in charge of managing things should also remunerate it at arm's length. So therefore, if you want to claim a certain income in a certain entity, this entity need to take care of the functions. So that just in general terms. And then last but not least, so the like substance requirements when it comes to managing reputational risk. I mean, this here obviously has nothing to do with tax anymore. This here is like gut feeling and qualitative journalism that might determine the standard of what is right. And here we say, like, in particular, say, like, multinationals that have a contact or that have a contact with end consumers might have a concern, but also asset managers, because I mean, depending on the investor profile and how conservative an investor is, I mean, obviously you want, or you do not want to be in the press, say, like, with negative lines in terms of how you manage your activities. So therefore, I mean, one always need to structure investments in a way that one feels comfortable. If all the tax authorities would be in, or would be not having the full picture, and by the way, like, given the higher level of transparency, one should not speculate on someone doesn't know about something. And on top of that, when this is a concern in terms of, like, reputational risk, one also need to feel comfortable with respect to that, so that the investments are properly structured, and then if a third person looks at it, does not have any kind of bad feelings about it. Yeah, so defining the right level of substance. So here we will not go into all the details, but just to speak about the aspects that are relevant to consider when defining the right level of substance. I mean, I hope by now it's clear there is no one-size-fits-all approach. Instead, one need to look at a more tailor-made setup that makes sense in a given case. And obviously, costs are also one concern, and one reasonable concern. And because, I mean, we have different ways to organize substance. So we might rely on an outsourcing model, or we might rely on an insourcing model, or we might rely on a hybrid model where some elements are insourced and other elements are outsourced. So, and here that depends, say, like, on, in particular, on the magnitude of the activity. So, like, I mean, if one has a big operation and say, like, 4 funds that live at the same time, I mean, likely the work involvement is a different thing than having just like one fund which is not so active. Then the question is also about like, yeah, items of income that will be realized. That refers to say like potential withholding taxes, for example, and then requirements from a foreign perspective. I mean, if, and that relates then to investment strategy, if, for example, the investment strategy is like, so like throughout the lifetime, we will not pay dividends, we only will pay interest, and at the end we will realize a capital gain. Probably there are no particular substance requirements from a foreign jurisdiction. And so if one can make that case, one can be a bit more relaxed about substance. And again, like I'm not advising on not arranging things properly. I'm just saying like it's important to see the red line in order to be able to stay away from the red line and to make something that makes sense. Then the jurisdictions involved are important because the tax authorities in different jurisdictions have a different attitude when it comes to substance, and some are more challenging than others. Therefore, one need to consider where the investments are made. And yeah, different ways to provide substance. Yeah, again, like one can rely more on an in-house model or rely more on outsourcing model. An outsourcing model as a tendency makes more sense if the operation is smaller, and the more and more activities are to be made for an investment structure, the more there might be say like also financial pressure to insource that, because eventually the outsourcing model becomes more expensive than the insourcing model. While at the beginning, I mean, if the operation is rather small, obviously like you probably just want to have like a service fee, because that is like more controllable than hiring people and having all the circus with like labor law and so on and so forth. Yeah, so I mean, we have now like 1:40. I wonder like, do we still have the time, or do you want to hear about like substance requirements in the current circumstances of lockdowns and quarantine mandates?
Maybe shall we first take the question in the chat?
Oh yeah, I have a question. Yeah, so here the question is whether a Luxembourg fund, arguably in the legal form of a partnership, that is managed by a GP, and whether this GP can only be managed by Luxembourg directors, or whether Luxembourg employees would also make sense. I mean, when it comes to a Luxembourg GP, here particularly important is it is particularly important to properly manage the corporate governance of that GP. So I would expect, say, like fairly experienced directors that are on the board of directors of that GP. And then these directors need to be as much involved as necessary in order to properly manage all the activities. If then, and again, that is now a common sense thing and like a question of practice. I mean, if there are a lot of activities that need to be done by the GP, depending on the functions performed by the GP, then eventually it might make sense to also have an employee. But I mean, that is more kind of a factual question. I mean, if the activities are limited enough that just the directors can take care of it and can monitor everything that is done on behalf of the GP, then this would not be an issue. But I mean, here in particular for the GP, and you do not want to run any risk, I mean, one should have like Luxembourg resident directors, and so like having them being properly involved in all the activities so that there are no questions around that. Because you do not want to take a risk that the Luxembourg fund is perceived to be a foreign fund from a foreign tax perspective. But the very fact that we have a foreign IFM rendering fund management services does not make this fund becoming a foreign fund.
And Sebastian also would like to.
Yes. Thanks, Oliver, for the detailed explanation. I think I've seen a few cases, and you mentioned this earlier on. Italy and Spain are particularly strict in their scrutiny of, let's say, directive shopping in particular. And I've seen, I think there was one relatively recent case where the Spanish tax authorities go through the effort of looking at the Luxembourg company register and directorship register and basically say, okay, well, you're using a professional service provider, and the director is also a director of, I don't know, 40 or 50 other companies. And there's, at the same address, you get 400 or 500 other companies registered. And they said, look, this might, and again, coming back to all the elements of substance, it's one particular tiny element in the big chain, but it seems to become increasingly relevant, at least to the Spanish tax authorities. And I think the Court of Justice ultimately ended up agreeing with them. My question is it's kind of a two-legged question. Is there a trend that you clearly see tax authorities, not just in Italy, Germany and Spain, becoming a lot more, let's say, aggressive to scrutinizing some of these structures, in particular when it comes to PSD and IRT with withholding tax exemptions? And the following point would then be, what is the typical, let's say, I'm not a tax advisor myself, but the typical areas of or problematic structures I can imagine, and in practice you see some structures that are probably not problematic at all, or the risk is incredibly low. But I can imagine that there are some structures that are a bit more problematic, or where the risk is in general a bit higher. So could you please elaborate on those 2 points? That would be greatly appreciated. Thank you.
Thank you for the question. And say, like, in general, as of today, we do not see a trend that other jurisdictions are now following the path of Spain and Italy. So just as a general point, however, say, like, again, like, considering the current public spending by governments around the globe, I think the expectation that tax authorities would become more relaxed would also be, say, like, a hope that has a very low percentage attached to that. And then when it comes to, like, investment structures that are more problematic, I think that what is more problematic is more or less gone already. I mean, you know, like 10 years ago, when you had, like, small holding companies of individuals that made, like, investments, say, like 5 or 10 million, I mean, that is, or that might have had a taste at the time when things are not properly managed. But then over time, you know, they introduced minimum tax. So it means, and say, like, all the service provider costs already the minimum tax. And then the increased level of substance requirement has finally eliminated these structures already, because the cost benefit analysis did not work out anymore. So I think today, and when I look, like, to my clients, I do not have any bad feeling with regard to any of my clients when it comes to substance, because all their setups are reasonable for the case. And then when it comes to using service providers, indeed one need say, like, to carefully estimate, like, what might be appropriate and what might be the reaction of the foreign tax authorities. In principle, say, like, even if you speak about, like, a service provider, I mean, a service provider is normally there, has a reasonable substance. So we have the Luxembourg directors, we have the foreign directors that in the normal circumstances come to Luxembourg. And then all decisions are taken in Luxembourg. And so, like, if the corporate governance is properly managed and documented, say, like, foreign tax authorities do not really have something to say. I mean, and now, like, say, like, the professional service provider in Luxembourg, and say, like, the CSSF limited also the number of mandates that people can take over. So that means people should not have say like 500 companies under their hand, and it's clear that this person cannot really monitor anything. So there should be a reasonable number of mandates that a person has, and it should be clear that they have enough time to manage in practice the relevant activities. And so then even an outsourcing model works. I mean, obviously, there's always like, yeah, I mean, what would make or what would be the better profile in terms of like not being able to be challenged? That would obviously be like, yeah, then independent directors with a very good like CV. But again, like in principle, both is defendable if things are properly managed.
Got it. Thank you, Oliver.
Oliver, I have a question. Actually, I have two questions, if you don't mind. First one, could you expand on reputational risk from a substance perspective? Just an example. And the second one, someone touched on employees being directors. So you have directors who are resident in Luxembourg. Then you have individuals who are on the frontier. For example, Arlon, Belgian director. And then you have another situation of a director who is an employee of their own company in Luxembourg, but they don't necessarily live in Luxembourg. Which one of those scenarios is valid? I know composition is important, but on an individual basis, can you explore that as well?
Yep. So I just for the profile. So okay, so we have the employees also being directors, and the frontier, and then frontier directors or frontier employees and directors.
So you have three. You have the standard resident director. Then you have a director who's resident on the frontier. They come in every so often for meetings. Then you have a director who's maybe living on the frontier, but they have a company, their own company, and they're an employee of that company, providing services as a director.
Yeah, so like that employees are also like taking the role of directorship. That's not an uncommon thing. So here the question is rather like, are these people like sufficiently qualified for the role that they are taking? I mean, obviously you do not want to have like a 22-year accountant, you know, like being indicated as the director of a major operation, because that doesn't make sense. But I mean, if you have like, say like reasonably experienced people, I mean, that's a common practice. Then the Luxembourg resident directors are definitely also like a good profile, not only on the paper, but then the question is like, yeah, I mean, are they independent directors, or are they directors that are say like employed by a service provider? So again, like I mean, there are different ways to manage that, but I mean, one need to understand like, yeah, there are better profiles and less good profiles in terms of like using people, but one definitely need to properly document that decisions are taken in Luxembourg, so like with the participation of all the directors. I mean, what is, for example, not good is, say like you have like 2 Luxembourg resident directors and 2 foreign resident directors. I mean, typically the foreign resident directors would be more senior in their organization, and would probably also rather call the shots. But I mean, when you have that situation, you know, like you need to make sure, you know, that you can document that the Luxembourg directors are really involved in the activities. So that should not just be the rubber stamp guy, you know, that signed documents. That is really, really important. And in particular, if you have a difficult investment jurisdiction, that's even more important to properly manage that. And that is something that you need to document, say like on a day-to-day basis, you know, like, and also in the minutes of the board of directors. In the past, one would probably have like summarized the key points that have been discussed in a couple of bullet points. Today, I would recommend like, yeah, I mean, speak about what has been discussed, speak about the pros and cons that have been weighed, probably the contributions that have been made by different people, so that also like then the Luxembourg people are showing that they are fully involved in the process. So that is really important. Then with regard to frontier workers, or like people living abroad and commuting say like to Luxembourg, that is also fine. I mean, we need to ensure that decisions are taken in Luxembourg. Then that people are employed by a company, and then the question is like, yeah, I mean, if they are employed by a foreign company, I mean, that obviously triggers like probably a number of topics, including VAT and social security. But in principle, I mean, why would someone choose this setup? Because there's a risk in relation to the directorship. And I would assume that if someone then operates via a company, they want to limit that risk. Because, I mean, over time, the director liability or the topic of director liability became, say, like more significant, and therefore one also, and that is also one element why like Luxembourg directors have a good interest or have their own interest to carefully review the stuff that they are signing and to be properly involved, because when they just sign documents and then there is an issue afterwards, it's probably for them, and that means then private liability.
Yeah, I think the point of a company director is also withholding tax, which is another discussion as well. So could you elaborate on the reputational part?
Reputational
Thank
risk.
you.
Yeah, reputational risk. I mean, that is really like more like a question of gut feeling than about tax. So it's like, I mean, obviously, like the cases that we had, like that was in 2012, and it was like, for example, Starbucks being put on the wall. And then they had like one quarter after that, and that was the fourth quarter of 2012. And I remember like, you know, the curve was like increasing, and then one quarter it went down, and then it went back the next quarter to continue increasing. So it means like people can be angry at times, but only for so long. But that is the one thing. If you now think about the context of alternative investments, I mean, if you have like, say like in particular, if you have like conservative investor profiles like pension funds and in Germany Versorgungswerke in this kind of investor profile, I mean, you do not want to be in the press because someone picks up like a completely unreasonable investment structure. So that means like, yeah, you have your own interest to make or to create an investment platform that makes sense when people look at it and look at the substance element. And again, this has not so much to do with say like tax, but it's more like what the layman would think about it. Apart from the layman standard can also not be ultimate a standard, because a layperson does not understand why there is more than one box, if you see what I mean.
Thank you.
So are there other questions?
Maybe, Oliver, this is Sebastian again, and I'm thinking ahead quite a lot here. We have pillar one of the kind of OECD project going on as well, and I think one of the items that is in there is that there can be physical presence without your traditional substance. So you don't necessarily need to meet the local requirements anymore. Now, I'm well aware that this is not really looking at the fund industry, because they're exempt according to the last blueprints. It's more multinationals, but obviously, I mean, there are quite a few of these structures in Luxembourg. Do you think, and again, we might be talking about 2, 3, 4, 5 years time here, but do you think if that gets implemented, and at least Janet Yellen has now voiced some sort of support, unlike Stephen Mnuchin, but if that gets implemented as currently stands, do you think there will be a big impact on, let's say, the number of these corporate structures, or just the fact that you need to have Luxembourg companies to, well, often it is for tax reasons, or do you think the impact of Pillar 1 ultimately will be relatively limited?
I mean, to be quite open, I mean, I did not dig into all the elements of Pillar 1, but indeed, I mean, first of all, for the alternative investment fund world, we should be less concerned because it's not there. And obviously, in the case of multinationals, where multinationals, and then, I mean, let's face it, in particular, we are speaking about like US multinationals having then their investment platform, the regional investment platform in Luxembourg. And so like over the last years, so like these multinationals have been aligning themselves to the tax law changes in the US with GILTI and all these legislation. And now with the Pillar 1, that means like, yeah, I mean, you can technically like, and not just Pillar 1, I mean, also that what is now presented by the Biden administration. I mean, these multinationals need to change their business model or to make certain changes in their investment structures in order to respond to these new requirements and to these new rules. But then again, like if you're operating in Europe, you need to have a regional investment platform. And by the way, it's probably rather EMEA as a region that is managed out of Europe. And I mean, these companies that are currently in Luxembourg, I would assume that they will likely stay in Luxembourg because that what happened over the last year after the BEPS project, and then so like with heightened substance requirements, and then multinationals looking at where do we have substance in Europe, and I mean potentially like one has substance in Luxembourg, some have substance in the Netherlands, some have real substance in the UK, and probably then some multinationals said like, yeah, I mean we are leaving Luxembourg in order to go to the UK or to the Netherlands, and others said like, yeah, we have an investment platform in Luxembourg and we will make that even more robust with regard to the future. And I guess like the process of multinationals making their choice because of tax development has been made by now. And I would expect that the multinationals that are currently in Luxembourg will stay in Luxembourg. And yeah, so that would be my basic assessment.
Got it. Thank you.
So I'm not too much concerned, even so like you see like today or Luxembourg today cannot compete with Luxembourg 10 years ago. But given that the tax rules and also the attitude of the tax authorities around the globe, in particular in Europe, around the globe, have been moving so much in the bad territory that even so Luxembourg also moved into a less good territory than 10 years ago, we are still the one-eyed man, which is the king of the blind.
Great, thank you.
Okay, so now we have 2 o'clock. So I don't know, like, I mean, I can still like quickly address like probably 10 minutes the question of like the current situation, if there is an interest in that, and if so, please let me know. Otherwise, I will leave you to your deserved afternoon.
Yes, sure, Oliver. You can go ahead. No problem. Okay,
so then say like probably let's speak another 10 minutes about managing substance in pandemic times. You also find a publication in the handout to that. I mean, obviously, and that picks up on one of the questions that has been raised in terms of like frontier workers, or also like, yeah, I mean, often we have like, say like directors then from Germany, France, the UK or Spain or whatever. And these people typically would fly in for example, like quarterly board meetings. As we all noticed, that was not so easy over the last 12 months. And when I first thought about substance in the context of these lockdown measures and quarantine mandates, I was thinking like, yeah, okay, that can be probably a question of like 2-3 months, maximum 6 months with a certain impact. But at the time, I didn't have the imagination that it could last as long as it does, because the economic consequences of this are just like unimaginable, even so we do not yet see it. But okay, so then when it comes to managing substance in these circumstances, so like Luxembourg and also other jurisdictions have released like say like regulation so that it's possible to, for example, have like hold like board meetings via video or a video conference or conference call. So that was say like a good thing. Then we had like OECD guidance according to which say like the current circumstance should be treated as a force majeure situation, so that tax authorities should not challenge companies that, for example, their tax residency is not in the jurisdictions because the people cannot travel to the jurisdiction to participate to board meetings. So that's all good. Nevertheless, I mean, the longer this situation lasts, and given the appetite for tax revenue will not decrease over time, so it will rather increase. And we saw that already, like, for example, with regard to frontier workers. So there have been arrangements with Germany, France, and Belgium that the general rules under the tax treaty would say like not apply for a certain period, and this period has been extended. And so people have been relaxed to work from home. Because I mean, under the tax treaty, it's so like if you work all the time in Luxembourg, if you live in Germany, Belgium, France, there's no issue. The income is taxable in Luxembourg. And then you have like, depending on the country, Germany, it's like maximum 19 days where you can work outside Luxembourg, including business travel, by the way. I think it's France, it's I think 25, and I think Belgium 30, but it might be slightly different between Belgium and France. But once you exceed this number of days, part of your salary will be taxable in the residence state. And so that was a concern, obviously, of the people. And so like there have been this arrangement between countries, but what I have been hearing is that say like Belgium, for example, went behind like rather hiring people already, saying that, yeah, in your case, it's not so easy just to stay at home because of your role. So therefore, I would just say like, yeah, I mean, I would not be too relaxed about things just because there's some guidance saying like, yeah, don't care. So therefore, now the question is like, okay, how can we do the best out of this situation? Because I mean, currently, like, say like regular travels are not possible. So that means like, yeah, when you have like, say like 2 Luxembourg directors and 2 non-Luxembourg directors, I mean, likely the 2 non-Luxembourg directors will not be able to participate to board meetings anytime soon. So then the question is like, yeah, how can we better manage, say like the substance and the corporate governance of a Luxembourg company? So then it might be a possibility, in order to move away from the red line, that one has the non-resident directors giving a proxy to the Luxembourg resident directors, and that then the Luxembourg resident directors, or I must say Luxembourg professional resident directors, it might be people living on the border, on the other side of the border, and commuting to Luxembourg, so that you then have like the Luxembourg resident directors or the like Luxembourg professional resident directors being physically in Luxembourg when the board meeting is held. They have the proxy of the non-resident directors, and the non-resident directors can dial in via conference call or video conference, and they can listen to what the Luxembourg resident directors are saying, but they would not intervene in the discussion, and they would not themselves take a decision from foreign soil. So that might make sense to say like to improve the substance picture in these circumstances, because again, like we do not know exactly how long this will last. So probably it will be say like another year, and then when you have like 2 years where the substance is not properly managed, I would start to feel uncomfortable. So yeah, so that would be my little overview. Apart from, I mean, obviously when you have like employees probably of Luxembourg companies also working, say like then in their home office, I mean, the longer that lasts, the more you also create like a potential risk with regard to permanent establishments. But okay, that's just a side topic that one should have on the radar. And if it's something that remains longer topic and is more imminent, then one probably needs to think about how to minimize any risk in this respect. So that would, yeah, the little excursus regarding managing substance in these extraordinary times. Probably just to finish up, yeah, with a little conclusion. Like, yeah, substance was always important, but only became more important as it was more in the focus throughout the BEPS project. And so, like, yeah, now we have like enhanced transparency, meaning like I would not recommend anyone to think about like, yeah, someone will not know. Let's assume everybody knows everything and will need to be comfortable with the substance profile, even if everybody, like all the tax authorities involved, would know everything about everything. Then there is no one size fits all. Instead, one need to look on a case-by-case basis what makes sense in a given case. Also, given then probably like the historic situation, like, yeah, what does an investor already have in Luxembourg and how to make best use of that. And yeah, so that means like investment structures today need to be much more tailor-made than in the past. And so that would be my closing words. So if there are still questions. So I guess that not. So then I wish you a pleasant afternoon and talk to you tomorrow about transfer pricing.
Thank you, Oliver. The recording will be available today, so you can have a look and summarize your questions for tomorrow. And see you tomorrow. Thank you very much for attending.
Bye-bye.
Bye.